Good morning, everybody, and welcome to our next monthly IFRS webinar. And this month, we're talking about navigating the complexities of determining fair value. And we know fair value is a topic near and dear to many of you, especially as you are finalizing your 30 June 2022 financial statements. So welcome to the session. As always, I've got Kevin Frohbus with me, and Kevin will be doing a lot of the heavy lifting today. So Kevin, welcome and nice to see you.
It is good to see you, Aletta, and it's wonderful to be back. I want to say that it's a bit cool in Sydney, but it does start to have a bit of a sniff of spring. So hopefully we're not far off from returning back to normal. Hello, Aletta. You're looking great, and a bit of Africa in your scarf. So good to see the home country represented.
Absolutely, especially for you, right?
Absolutely.
And as soon as the weather is amazing in Sydney, I think I need to come and do a visit. Last time we did that beautiful harbour cruise. You know, Sydney is such a beautiful place. Anyway, so welcome to the session. Welcome, Kevin. I thought I'll do a few reminders up front. No, we've been talking about sustainability and ESG for quite a while, and a lot of clients have been saying to us, listen, we believe in sustainability, we believe in ESG, we want to make a difference, we know we have to consider climate risk and sustainability risks as part of our OFR, etc. But when we look at 30 June 2022 financial statements, a lot of clients are currently experiencing, you know, staff shortages, as most people or most entities in Australia, and there's a lot of competing priorities, and maybe sustainability and ESG has not been top priority for 30 June. Let me just see, sorry, I just want to change how I share my screen. I don't know, sharing, excuse me. I hope that is better, Kevin. Can you see less of my icons and stuff? Anyway, a lot of people have been saying, listen, we're interested in sustainability, but it's not been you know, top priority. Hopefully after we finalize 30 June 2022 financials, we'll get an opportunity to revisit. And therefore we thought we might just flag that we've just concluded our first 6 months or the first 6 sustainability webinars. But we have scheduled another 3 till the end of the year. Kevin, it's a bit scary that we're already scheduling webinars for October, November, December. In October, we'll be looking at decarbonisation 101, so decarbonisation strategy. And then in November, we'll be looking at ESG-linked remuneration, which is a really hot topic at the moment. So how do we remunerate our executives and link their remuneration to achieving ESG targets? And then in December, we want to explore with some of our corporate finance partners what the impact of ESG on their due diligence processes are. So in September, there's not an ESG webinar. We thought we'll take a rest in September and let people finalize their 30 June 2022 financials. So 3 new webinars on ESG. The other thing is, Ashley Bleeker and I are continuing to do a number of sustainability and ESG workshops. Now, sometimes boards come to us and they say, Aletta, we can give you 30 minutes at our upcoming board meeting. Please do your best to maybe explain to the board what sustainability is, what ESG is, what the importance is. And sometimes they say we can give you 3 hours or we can give you a morning. So we are very happy to use whatever time you can give us. These workshops are free. We're trying to just encourage people to consider sustainability in their business, and we consider the risks for the business if they ignore sustainability, but also the opportunities for the business if they embrace sustainability. So please feel free to reach out to me if you're interested in that. I think over the last 6 months, Ashley and I have been doing ESG workshops for boards, at least 3 a week. Some weeks we do more than 1 a day, but very happy to do that and help to spread the message. Then, an old chestnut and an old favorite, are you struggling with lease accounting? So as you know, Kevin and I have a group of people in our team that are dedicated lease accounting specialists. They're our lease accounting advisory team, and they use our software to help clients, and sometimes we sell the software, BDO Leads Software as a Service, and sometimes the clients outsource lease accounting to us. Now, this is usually the time of year where people come running and they say, I'm sick and tired of Excel, and I'm sick and tired of staying on top of these lease agreements, sick and tired of CPI adjustments, COVID-19 rent concessions. And also a lot of our clients are saying, because we are so short-staffed, and again, we hear it here, because we're so short-staffed, we want the people who know our business really well to do other more important things. And we are very happy to outsource the compliance part of our business, the compliance around lease accounting to you guys. Take the stress of that away so we can focus on our business. So again, I've included some links to videos where I try to give an overview of the benefits of using the SaaS offering versus the outsource offering. And I should say more and more, we actually have clients who use both at the same time. So the client would say, I've got 2,000 leases, or I've got 200 leases. I want my own software, BDO Lead Software as a Service. But by the way, I've had a lot of staff leave or staff turnover. Therefore, instead of teaching them how to use your software, can your team just do it for us? So they actually get the best of both worlds. A lot of clients do that. And the other thing is, this time of year, a lot of people finalizing financials. The question is, where can we find, BDO, IFRS and corporate reporting information? Obviously, we've got our corporate reporting insights that come out every month. And we've got a lot of sustainability articles, Australian developments, and we've got articles on the lodgement exemption around grandfathered entities that's being scrapped, all the latest developments around AFSL. So it's really jam-packed, so register for that. Obviously, the monthly webinars. On the website, we've got a lot of information. If you look on our website, there's a page for our publications, which is really comprehensive. We've got a training hub, and in our training hub, you can get a lot of information around various topics, and we've grouped it per topic. And in our training hub, you can register for webinars, seminars, e-learnings, etc. So again, at the moment, because a lot of people are doing general purpose financials for the first time, we're getting a lot of requests for face-to-face training, or some people want to look at recorded webinars, recorded seminars, or even e-learning. So just a reminder of everything that's actually available there. I think at the moment what we're seeing a lot of is the whole conversation around sustainability opportunities. We're seeing a lot of need for people putting their hands up and saying, help with this lease accounting. Let the nerds deal with it. We want to focus on growing our business. And then the other thing is, a lot of people doing general purpose financials for the first time are saying, we're looking for training that is potentially self-paced at a time that's convenient for us. Now, today's agenda, we're going to discuss three things. First of all, the question is, why are we discussing fair value? And then a very important question, and we put it right up front, do we need to use external valuers in order to determine fair value? And then we're giving you a bit of an overview, or Kevin will be doing a bit of a flyover around first principles when determining fair value. So first of all, why are we discussing fair value? Now, when ASIC brought out their focus areas for 30 June 2022 reporting, and actually, Kevin, for as long as I can remember, one of the ASIC focus areas have always been asset values. So they focus on a number of things. Usually they come up with around 10 things they focus on, and asset values and determining asset values is usually fairly high on that list. And in particular this year, they said, we believe entities should consider the impact of changing circumstances uncertainties and risks on asset values. So, we know there might have been COVID-19 conditions and restrictions during the reporting period. What does that mean for asset values? There could have been changes in customer preferences, online purchasing trends. We can also number the third bullet point there, the impact of rising interest rates on future cash flows and on discount rates that we use to value assets and liabilities. We're looking at, it's back to sustainability, commitments and policies on climate and carbon emissions by government. What does that do to asset values? Does that mean our assets are potentially not as valuable as we thought they are because they'll be out of date very soon? What about technological changes and innovation, legislative and regulatory changes, and other economic and market developments? So think about all your assets on your balance sheet, and if you're happy with those asset values in the light of all these latest changes. Now, what ASIC has then also done is they specifically flagged values of property assets. And they said, right, it could be that factors could adversely affect commercial and residential property values, and those factors should be considered when we determine fair values of property assets. They also say, remember, when we look at lease accounting requirements and we look at the treatment of rental concessions by lessors and lessees, we should consider the potential impairment of a lessee's right of use assets. They also flagged the value of other assets. They said, what about the value of investments in unlisted entities? They flag net realizable value of inventories. They flag whether it's probable that tax assets will be realized. So a number of items flagged by ASIC around asset values. I think the other thing to look out for is that ASIC every 6 months come out with their results from their ASIC surveillance. And the most recent results were based on the 31 December 2021 ASIC surveillance on financial reports. And again, there's a theme around impairment and asset values. And in asset values, they include, goodwill, other intangibles, and property, plant, and equipment. And again, they explain, it's around reasonableness of cash flows and assumptions, having regard to whether they are supportable based on historical trading results, ongoing changes in market conditions again, and then also the use of fair value to determine recoverable amount, discounted cash flows, and then entity uses its market capitalization as an estimate of fair value, etc. Now, I think the one thing that comes through in all these slides where we talk about the asset focus areas, it's two things, Kevin, that seems to be a little bit confused and put together. And that is impairment testing of assets, and the other thing is asset values per se. And it's interesting that ASIC in all these publications group the two together. I know they broadly relate to the value of an asset in the balance sheet, but we've got very different rules when we do impairment testing and how we do that, as opposed to determining fair value for assets that are carried at fair value. And, I think that's one of the things we should maybe talk about upfront, and I know we'll get back to it later in the presentation, is often when we look at an asset is to ask yourself the question whether this asset is carried at historical cost, is it carried at fair value? What am I trying to do here? Am I trying to come up with a fair value for the asset, or am I doing an impairment test? Because when I do an impairment test, there's other things at play. So we'll unpack that a bit later, but I'll just leave that because even in the ASIC publications, they seem to be grouped together, which can be confusing in my view.
Yeah, Aletta, that's a good point, and I'll jump in here because I think that's how we've constructed this webinar today. is navigating the complexity of fair value is to actually unpack exactly what you're measuring in the first place before you even get to the calculation. Now, I'm going to talk today in the concept of preparing for evaluation, because I think that's actually 90% of the problem. In corporate reporting world, preparing for the valuation is like I say, 90% of the effort, and the actual valuation itself, although there's a specialism there, can go off the rails completely if you don't get the preparation right. And so where Aletta's talking to you about things like impairment versus fair value, understanding that complexity to begin with is the first step before you even get to the calculation of fair value, because very often you need to brief a valuer in many of these scenarios. Now, the reason why we started with do we need to use an external valuer is because this is probably the most common question we get, or at least I get. I don't know about you, Aletta, but when we get into valuations and fair value, I will often get from clients, do I need to appoint an external valuer? Like, is that a requirement of the standard? And the answer is no, it's not a requirement of the standard. But what is a requirement of the standard is if you're going to do evaluation, you need to know what you're doing. That's what it, reliability of measurement. And so that often involves dealing with an external valuer. And dealing with an external valuer, they will need a briefing from you. So most of the people on this webinar are CFOs and board members and financial controllers, and shall we call them finance people. I would bet that I can't imagine there would be too many exclusive valuation specialists on this session today. But if you are on the session, I would imagine that you would agree with me that you need to be briefed properly by your clients before you jump into evaluation on what is the purpose of this valuation, and what am I valuing, and is it for corporate reporting purposes? Because if it's for corporate reporting purposes, you are in our world of navigating complexity. And at that point, three sources of standards and frameworks become applicable. Now, the one we're going to speak a lot about today is AASB 13. That is the standard fair value measurement that essentially tells you how to approach fair value measurement when you're doing IFRS or corporate reporting. It does not tell you how to actually do the valuation. It tells you how to approach the valuation. It tells you how to establish things like, what am I valuing for corporate reporting? It tells you things like, how do I approach it in terms of where do I get my inputs into my calculation? It tells you things like, do you use a market, an income, or an asset-based approach to valuation? And those are essentially, it's a framework that frames the approach. And the valuer who's doing the valuation will need certain answers to questions before the valuation is done. And those are generally driven by AASB 13. So that's where Aletta and I live. We live in the AASB 13 world, but it's essentially the approach standard. I'm approaching my valuation, and when the valuation gets done, the valuer, whether it's external or internal, will then take valuation standards, which is the IVSC standards, International Valuation Standards Council. They prepare standards on how to actually do evaluation. Now, I'm going to tell you right now that I might have read one or two of those, but that's not my world of specialism, because that's where specialist valuers will go to actually apply, shall we call it, internationally accepted valuation concepts and valuation approaches. But they'll take the AASB 13 approach and they will feed it into their calculation, and off they'll go. Now, back to the question, do you need an external valuer? No, you don't. But you probably want to consider one for certain types of assets. You know, if you're valuing land and building, I'd imagine you want to get a valuer. If you're valuing a specialized type of equipment, you'd probably want a valuer. If you're valuing shares on the stock exchange, probably don't need an external valuer because you're just going to use the share price from the exchange. But if you're valuing a share which is not traded and is thinly traded, and perhaps is also of a company that is, I don't know, got a whole bunch of intangible and development assets on its balance sheet, well, maybe you do need a specialist valuer there, because once again, the type of underlying asset is complex. Auditors would appreciate an external valuer, and you probably do need to balance cost and effort when you approach these things. But the most important thing from an audit point of view, and also a reliability of valuation, is APES 225. Now, APES 225 is the valuation standards that professional accountants and members will follow when they're preparing a valuer. So when BDOs, corporate finance teams, do valuations, all our reports will be issued in accordance with APES 225. It's almost the hallmark of reliability that you've got somebody who, first of all, belongs to a professional association, and they're following our ethics standards and our quality standards in Australia, APES 225. It's called Valuation Services. Why that's a hallmark of quality and success is because you know that, first of all, not only are they part of a professional body, as I said, but they'll follow certain approaches to the valuation. It establishes reliability, and essentially they will be the entity's specialist for that valuation. Auditors will talk to those people in a different language because they'll acknowledge that the valuation they're getting at that point probably has a certain level of reliability on it. If you do an internal valuation and you don't have APES 225 and you're not a member of a body who's following that, at that point it becomes harder and harder to accept reliability of the valuation. So it's the reliability of the APES 225 standard that will drive, do I need an external valuer? And your auditors, for example, and your regulators, ASIC, will be so much more comforted by an APES 225 evaluation than if it's done internally. So that's just a method there. Okay, so we're going to talk standards and frameworks. AASB 13, that's the standard that is your approach standard to corporate reporting valuations. If you're valuing something at fair value in accordance with corporate reporting standards for financial reporting purposes, most of the time you'll go to AASB 13. There's exceptions, we'll come to those. That'll set up what are you valuing, and you'll brief your valuer, and your valuer will then go and do the valuation, normally in accordance with international standards, but also in an APES 225 world, and they'll go do the calculation. Now, the purpose in the AASB 13 world is for corporate reporting purposes. When you're valuing something in accounting, the purpose under AASB 13 is for financial reporting purposes. If you've got a valuation and it says it's an insurance valuer, it's probably not going to be valid for a corporate reporting purposes because the purpose is for insurance. So AASB 13 establishes that purpose. I'm doing this for my financial statements and I'm doing it at fair value. And that'll be your approach standard. The other thing I want to actually say about, do you need an external valuer? The reason why you often get external valuers is because they'll do certain things, and one of those things is they'll do a cross-check, and that is a hallmark of reliability. If I'm valuing, let's say, specialized piece of equipment, they might use an asset replacement basis for that, or they might use a market value, and they'll often do a second valuation, a secondary valuation as a cross-check. That also establishes the hallmark of reliability, and generally an APES 225 valuation will do that too. So that's just, you know, the sorts of qualities on the characteristics you should look for when do I need an external valuer. Okay, hopefully I've established this. We'll jump through it then. And start moving on to, you know, some of the basic concepts. And I think we're going to do, yes.
I'll just agree that I think whenever we ran into issues with valuations is where potentially the valuer didn't do an incorrect valuation, they were briefed incorrectly. And I think it's really important that, and the auditors will always ask, you know, how have you briefed the valuer? Have you articulated it's for corporate reporting? Have you articulated they have to comply with IFRS 13? That purpose of the valuation is actually really important. So yes, valuable comments.
And Aletta, those are the perfect example actually comes back to impairment. So if you're valuing, or if you're doing a cash generating unit, or you're doing an impairment value in use calculation, you'll be valuing a business or a group of assets that generates, you know, inflows or revenue. Now that by definition is an enterprise-based value. So if you, in valuation parlance, you're actually valuing, you're creating an enterprise value. What I often see when I get to impairment is I'll get a valuation of the shares of the company. I'm like, well, hang on, why are we valuing the shares? Because impairment requires a valuation of the cash generating unit. And the reason why there's a disconnect is the valuer wasn't briefed properly. The valuer was briefed, can you value my business? And what did they do? The valuer went and valued the shares, and that might be valid for something else, But when you're doing an impairment test, you're actually valuing the CGU. And so that's where briefing the valuer becomes important. The valuer will know what they're valuing in terms of briefing. What am I doing? Unit of account. And that's where AASB 13 comes in. And that's where we run into issues. Any valuer worth his salt will ask the right questions before they do evaluation, but Aletta's point is valid. If you don't brief them on, this is for corporate reporting, and this is the asset I'm trying to value, and this is the accounting standard I'm in, they're going to value the wrong thing, and then you're going to run into problems. So they can generate APES 225 reports and use the international valuation standards appropriately, but if they briefed incorrectly, they're probably valuing the wrong thing to begin with. And that's the purpose of today's session. So we'll jump into first principles, scope and unit of account. I always say that IFRS or corporate reporting specialists are specialists not in the accounting standards. They are specialists in understanding which accounting standard they are in. That is what an IFRS advisory specialist is all about, because it's finding out where you are in the accounting standards. If you don't know how to apply the scope and you don't know how to move to the right standards, you probably can't do the rest, because that is the trick in IFRS. So the first thing with understanding where you are and what you're doing is, which standard am I in? In other words, what am I valuing and which accounting standard am I valuing it for? AASB 13, as I mentioned before, is a framework standard, an approach standard on measuring fair value of an asset or liability. It technically is where you go to do the measurement of something at fair value. You get there by coming from another standard. So if I take, for example, property, plant, and equipment. If you are measuring an item of property, plant, and equipment, let's say land and building, and you're measuring it at fair value, you're getting to the AASB 13 standard from the property, plant, and equipment standard, AASB 116. It's telling you, I'm starting with my item of PPE and I'm going to AASB 13 to go and set up my approach to valuation to brief my valuer. That's the important bit. But AASB 13 does not apply when you are doing measurements of certain standards, such as share-based payments and leases. And the reason for it is those standards have their own measurement rules. So if you take a share-based payment, let's take an ESOP, employee share scheme, you'll often run something like a basic binomial method to calculate the value of an option. That will be valued under the share-based payment because you're valuing the value of the option as a proxy for the value of the good that the employee has delivered to you, the employee goods and services. So AASB 13 is only your approach standard for certain things. Lots of things are covered by 13. Most of things that are measured at fair value under IFRS or under accounting standards, you end up under AASB 13, but not all. So you really need to be clear where you are to begin with. Same thing with in inventories. Net realizable value is actually dealt with by the inventory standard. It's not dealt with under AASB 13. And like Aletta said, value in use for impairment. If you are doing an impairment test of a cash generating unit under the impairment standard, you're under the impairment standard, AASB 136. However, and here's the trick, impairment is the higher of fair value or value in use. So if your fair value is higher than your value in use, you're coming to AASB 13 to do the fair value measurement. So look at that interaction. So you kind of need to know where you are. I always think about it. AASB accounting standards, it's pretend you've got a blindfold on and you're working your way through it. That's what you're doing with scope. Where am I? Where am I coming from? And where am I going to debrief my valuer? And not everything is under AASB 13. So know where you're starting from and know where you are. I'll give you some quick examples on the next slide. And I'm going to spend a bit of time in this because it's really important for you to understand before you brief your valuers. One of the things I've seen a lot on lately is warrants that are being issued. And warrants, traditionally, you find them in financial instruments. So I'm raising finance, with a convertible note, or I'm raising finance from an investor, and I issue them warrants. Very often, those will be under our AASB 9 financial instrument standard. But I'm seeing more and more share-based payments in the form of warrants. And those are issued to employees or maybe even non-employees when those non-employees are providing services to the company, which is very different to a financing arrangement. So there you've got an instrument, warrants, which could be under one of those two standards, share-based payments or financial instruments. Now, in theory, you should not be valuing the warrant under AASB 13, the fair value measurement standard, if you're under the share-based payment standard, because share-based payments have their own measurement rules. However, the same warrant issued under a financing transaction to raise funds would be under AASB 13 if it's under the financial instrument standard. So knowing what the nature of your warrant is and what its nature is, what it's for, and which standard you're under will drive you to the appropriate measurement rule. So that's really important. Same with leases. Now, you'll know from previous webinars that I've done with Aletta that we love the community housing industry, and I find this often happening in the community housing sector, where they will have leases, residential leasing, which happens to be an ASIC focus area. Notice residential leasing and the values around it, but some of them actually rent those properties out to social and affordable housing tenants, and they account for it as investment property. Investment property, by its definition, is a valuation of an underlying asset and the rights over it to use it. And you may find yourself heading towards AASB 13 in some scenarios, but in other scenarios, you'll find yourself back out in the leasing standard, and you'll not be using AASB 13 as your approach standard. So all sorts of interesting things there. And the other one I ran into the other day was inventories broker-dealers. Broker-dealers, depending on what they're brokering, sometimes measure instruments that are under AASB 13 measurement rules, but for the most part, inventories and net realizable values are actually not part of AASB 13. So you can see just in the scope paragraphs, I can come up with example after example after example of, am I in the right standard, and am I actually in the AASB 13 fair value measurement standard, and how did I get there? And this is the sort of thing that you need to understand before you appoint a valuer, before you select a valuer, before you brief the valuer. And the valuers on the webinar today, you should be asking these questions before you jump into the valuation too. What am I doing this for? What is its purpose? Is it financial statement or corporate reporting purposes? And what am I valuing and which standard am I coming from? Because it'll drive the briefing on the valuation.
So Kevin, this is an interesting thing. You and I often work with valuers at BDO, and the reason we work with them is the client have asked the valuer to come up with a valuation, and the valuers start to say, hang on, why am I valuing it? They're asking all those good questions. And then suddenly they come back to us and they say, please tell us, which standard are we in? So are we in, because our valuers can determine a value using the share-based payment rules in AASB 2, the binomial options and whatever. They can use any of those tools, or they can do a fair value as required by AASB 13. But they don't know which standard they're in. They don't know which models and tools they're supposed to be using. That is driven by the accounting standards. So I think that's where that interaction between your IFRS expert and the valuer is actually quite important before they go and do a valuation that doesn't meet the objectives for you, and the auditor won't accept.
Absolutely. I always say the unholy trinity when it comes to valuations is to make sure your accounting specialist or IFRS advisor, your auditor, and your valuer are all talking to each other. And it's always a good idea to have the three of them aligned into what are you going to do before you actually get the valuation. Because let's face it, the valuation is actually, if you appoint an external valuer, they're going to charge you a certain amount of money for that valuation. But if you spend just a couple of hours up front making sure the unholy trinity, the three of them at the beginning, all agree on the approach, it could be the best investment before you actually pay the valuer, because nothing is worse than getting a 30-page valuation report from a professional valuer only to find out during the audit phase that you valued the wrong thing. And that may be the biggest takeaway from today. And this is a good slide here, the unit of account. I just pulled this in at the last minute before today, Aletta, which is, what are you valuing? These are examples of, shall I call it, the approach to AASB 13. So knowing what you're valuing before you're valuing it. When you're valuing property, plant, equipment, you're valuing the item. And we've got examples like land and building, and then you'll brief the value accordingly. And by the way, you should probably make sure your valuer can split out the land and the building valuation for you, because buildings get depreciated and land doesn't. So you need to know the actual split between land and building. Otherwise, you can't do the follow-on accounting. So once again, there's understanding your approach. Intangible assets, investment properties, biological assets, it's all the individual item. But here's an interesting one: biological assets. I somehow have found myself wading knee deep into orchard valuations recently. And valuers generally don't value the fruit or the tree; they'll value the entire orchard on a piece of land. But what we're actually accounting for are the individual trees. So you got to agree with your valuer and also your auditors and so forth before you launch into it. Is the number that's coming out of the valuation a proxy for the individual item underneath what I'm valuing? So these are the sorts of issues to think about. Jumping through into the next slide, equities. I think this is where we deal with derivatives and so forth. I'm going to jump past the individual debtors for now and go straight down to investments in associates, subsidiaries, and shares. This is a tricky one, because when you are valuing a subsidiary or an associate, you're valuing your holding. But when you're valuing let's say a 10% share in a listed entity that's not a subsidiary or associate, you're actually valuing the individual share multiplied by the number of shares I have. And the valuation of a share and the valuation of a subsidiary holding, which includes a control premium, can give you two very different answers. Because the share doesn't involve control premiums and discounts, and I'm sure you'll know what I'm talking about if you're on listening today. Whereas if I have an investment in a subsidiary, the control in that subsidiary gives me a little bit more value in that holding, and so I'm probably going to value the subsidiary including a control premium, where individual shares, if I don't have control, are going to exclude discounts and control premiums. And that's important to understand before briefing your valuer, because are they valuing the holding in the subsidiary or the associate, or are they valuing the individual share multiplied by the number of shares? This is all approach. Okay, now we have spent a bit of time on that, and the reason why I did is because the parts that we've dealt with are probably the more complicated things I wanted to cover, and make sure you know where you're starting from. I'm going to whip through the definitions relatively quickly because I think these are going to be self-explanatory. These are just approach definitions from the standard. We're valuing an asset or liability as an exit price. In other words, as what we would sell or realize the liability or settle the liability. Or paid to transfer a liability. Sorry, I literally said the wrong thing there. Not to settle a liability, to transfer a liability. That's very different, and I just actually got caught out by myself. Fair value is a price to receive to sell an asset or to transfer a liability. That's different to, for example, settling a liability. Very different answers there, because what I would pay to settle a liability, what somebody else would be paid to transfer a liability to them, gives you different answers. And that's why getting these definitions correct is important. I literally made an error myself, Aletta, in approach. So
yeah, and I think it's because you were thinking in your head, I shouldn't say that, and then you did
exactly
it, right?
So and that's important to understand, is you get those terminologies right. In an orderly transaction between market participants at the measurement date. None of these concepts a valuer can help you with. You need to brief the valuer on these concepts. What's my measurement date? What's my asset? What's my liability? Etc. etc. Jumping through, then I'll jump through to the next one. It's principal or most advantageous market. These are concepts in AASB 13 which are often overlooked because they framework concepts, and most valuers, once they know that they're valuing an asset for corporate reporting, they will take over this concept, which is, where do I find my the market where I'm going to sell this asset, let's say, in and realize its value. They will look for the market with the greatest volume and level of activity, which is why we use a stock exchange as the market to work out pricing when we're valuing a share that's traded in the stock exchange market, because that's where the greatest volume and level of activity is. It's also the source of the most reliable observable input information. Where observable and principal market become exciting is once again in biological assets. As a good example, if you've got cattle on a station out in the middle of Australia, but the market is in Alice Springs, you need to consider the location of that market and transport and transaction costs to get, let's say, the cattle to market, and that will feed into the valuation. And they're all important, and they'll, to brief the value on those sorts of things. Principal market wins over most advantageous market, not always, but as a general rule. The reason for that is, where is my greatest volume and level of activity? Because that's the market you're generally going to look for. It's also where your reliable information is to actually, do your valuation. Yeah. Most advantageous market, by definition, is an anti-avoidance measure. They don't want you to use most advantageous market because that's going to increase the price, but that's not the reality of where you're actually going to sell the asset. So principal market is what you're looking for. Valuers will know how to deal with this once they're briefed. For non-financial assets, highest and best use is also important, and you will find in property assets this is quite important. So the concept of highest and best use is pretty much the price that will be paid by a market participant given the best use can be made of the asset, irrespective of current use. Now, I'm going to take property, mostly because ASIC is focusing on this in their what do you call it, focus areas at the moment, property valuations. Yeah. And property is a good example of what we talk about highest and best use. When you are valuing, let's say, land and building for fair value purposes, the highest and best use is pretty much what the market participant would do to maximize their value. If I've got an asset and I've got a office block of office complex on there, so but I'm using it essentially as office leases to tenants or to commercial tenants, that is essentially its current use. That's also the use that I would use if I'm doing a value and use calculation. But that's not necessarily what the market participant would be. If the market participant would buy that property, knock it down, and build residential apartments on it, then the value, the fair value, will be determined on the basis of knocking it down and building the residential apartments, because that's what the market participant would do. That is really important. It considers things like what's physically possible, what's legally permissible, and financially feasible. This can become really problematic for your not-for-profit entities. Not-for-profit entities often are gifted land and building to do certain things with, but that's not, and they sometimes are constrained. They can only use the property in accordance with whatever their purpose is as a not-for-profit. So maybe come back to community housing again. Community housing providers might have to use it for social housing, but that's not necessarily what a market participant would use it for if they bought the asset. Sometimes the constraint on what you can use the property for transfers with the property on sale, but often it doesn't. Sometimes the constraint belongs to the entity, and that's really important. Understanding what the constraint is, and is that constraint relevant to the entity or to the asset, and whether it would transfer to the market participant in a sale, is really important to understanding whether it's factored into the valuation when you do the valuation. Aletta, I know you're agreeing with me, because you and I came up together in the world of not-for-profits, and we have had so much fun with constraints, in particular in the not-for-profit world.
Yeah, because with not-for-profits, I'm thinking, thinking of that great location of the golf course, but should it always be a golf course, or can we buy that property and, put high rises in there because it's got a beautiful view, great location? Absolutely. A lot of not-for-profits think about schools, for example, have fantastic land, but, can they only use it to run a school or to run a certain type of school? you know, what are the restrictions that's being placed on that not-for-profit? And again, is it associated? You can only use it as a school for this entity, but, you know, can the entity find another location and sell that property? You know, so sometimes we find that they say, let's sell the property because there's no restriction to continue to have a school here. Let's sell it, get a lot of money, and go and build a school maybe in a different area where it's cheaper to find the property. You know, so that's really important. It gets really complicated in not-for-profit world.
Yeah. For those not-for-profits on today, and also any other entity for profits who have constraints over what they can use, let's say, non-financial assets for, I would recommend that you make sure your valuer addresses that in the valuation report. Identify the constraints and discuss how they've been treated in accordance with 13, and the valuer has included or excluded it in the approach. And if we come back to let's say property again, very often a valuer will look for recent market transactions in an area to value the profit. So that's a market approach to valuing it. But the transactions they compare to might not have the restrictions that the asset have that you're valuing, and the valuer needs to adjust for that, or at least consider how that interacts. If I'm looking at a valuation report and the valuer hasn't addressed it, that's not necessarily the valuer's fault. That means they've not been briefed properly. And that is where the complexity comes in, which is what we're talking about today. All right, so we'll jump past that. I think I'm going to, the highest and best use, we've spoken about this. I think that's a concept. I'll move past that slide a little. I think I'll probably kill that one to death. Fair value hierarchy, this is just some basic definitions and first principles again. The reality of this is a lovely slide. I love this slide. It summarizes something like 4 pages out of the standard. So Aletta, well done on this slide. But the high level summary of this is, when you're doing your valuation, you really need to start with maximizing quoted prices for identical assets in an active market and prioritizing using those types of inputs in your valuation. This is a reliability framework. We're trying to value our asset or whatever we're valuing using the most reliable inputs into the valuation, starting with what we call level 1 inputs and working down to level 3. Level 3 are significant unobservable inputs. The reality with unobservable inputs is that they are often entity generated inputs, which means they're actually probably more value in use type inputs versus fair value inputs. Because what happens with unobservable inputs, the more you move towards using an entity determined unobservable input, you're looking at things from the entity's point of view, which means you're probably not so much looking at this from a fair value market participant point of view. So maximizing the other side of the scale, which is your quoted prices for identical assets in an active market, is where you want to start. I think I'll leave it at that. The valuation techniques, there's really 3 types of valuation techniques in the standard, and by the time you get to valuation technique, the valuer will be taking over at this point, because what they'll be doing is they'll say, all right, we know what the asset is, we know which standard we've come from, we know what the unit of account is, we know where our maximizing inputs are, we also know what our constraints and our highest and best use is, we also know where our market is. They will then choose, consistent with the market participant approach, the appropriate valuation technique. Market approaches such as using multiples or recent sales transactions for property. Income approach is using, let's say, discounted cash flows, and cost approach, which is like a depreciated or current replacement cost approach, which is often the approach for specialized assets and infrastructure type assets. And what will often happen is they will do a cross check if they're doing an APES 225 using one of the other ones, just to check that they're getting the right answer. Those techniques are driven, they're not a choice. They are driven by what the market participant would use. So what is the market using to value these assets under this framework? It's not a policy choice. It's not a selection. It's a primary and secondary technique based on the market approach, and the secondary technique is the check, which is often a second approach, not the primary one that the market is using. Those concepts you can talk with your valuers on. Okay, The most favorite thing in the world. Like Aletta loves leasing, and I like it too, but I like impairment. That's my thing. So let's talk impairment. Fair value versus impairment. I couldn't help myself. Coming back to this point today, where Aletta was speaking earlier about ASIC will often group impairment and asset values together in their focus areas, but that does conflate the problem. The question is,
Yeah.
which one are you doing? So this is a repeat slide from earlier today, but what I really wanted to get onto was the next. I think there's 3 slides, and I've pulled these in. Make sure you know what you're doing. If you are doing impairment and you're often valuing a CGU, you're in a different standard, which is AASB 136. What is value in use? It's the present value of the future cash flows expected to be derived from the asset. Discounted cash flow, 5 years, off you go. Fair value is the price that would be received to sell an asset in an ordinary transaction. In other words, this exit price notion. There you're starting with AASB 13. Now, because impairment is the higher of these two, very often we just use value in use, but sometimes the fair value is higher. And then you have to apply 13. And 13 doesn't necessarily mean you're using a discounted cash flow. What it is you're valuing it according to how the market would value the asset. And sometimes that's not a discounted cash flow. Sometimes that's actually a market price or even an asset-based price. So that's the first thing. You need to know where you are. On the next slide, I've put that down, and notice how I've highlighted in green market approach, cost approach, or income approach on the fair value side. Because what's happening there is the market cost approach or income approach is pretty much driven by the market participant and how the market would value the asset using the right approach. The value in use is pretty much discounted cash flow on a 5-year basis. Now, the last slide on this is really, when is it appropriate to use fair value in an impairment test? Now, value in use impairment of assets under AASB 136 is pretty much focused on goodwills, intangible assets. Yes, there's PP&E and so forth, but there's a whole list of assets that are not covered by that standard because there's a different standard that applies to them. And on the fair value side, when you are doing impairment and you are applying fair value for your impairment test, in other words, you're looking for the higher of value in use and fair value, it sometimes is not possible to use fair value. And ASIC has a very particular view on this. And I'm just pointing it out going into this period again is, you cannot use fair value when the range of the possible fair values is so broad under the fair value standard that really what you've just done is you've defaulted back to a value in use calc. So before diving into fair value, specifically if you're doing discounted cash flows, be careful that you, first of all, are not using a value in use by default. And I'll give an example of that. When you do a value in use calc, you are doing cash flows, which are based on budgets that are prepared by an entity. When you're doing fair value, you are looking at market assumptions and market valuation techniques. But if under fair value for an impairment test, if you are basing your fair value on an income-based approach, which happens to be based on discounted cash flows, and those cash flows are coming from the entity's budgets, you may already be in the value in use side already. You may not actually be doing fair value anymore. So that's the first step. But the second step is sometimes by doing a fair value calc, because you might be using level 3 inputs to do your fair value calculation, you may actually be so far removed from a reliable market valuation that you've actually got this massive range in your valuation outcome. So you don't have a point outcome. What you've got is a range of possibilities. And maybe it's an asset that's worth $1 million or $10 million. That range is too big for reliable measurement. And for impairment, ASIC will often not accept that as an approach, because they'll say to you the range of possible values is too broad. And that comes from a paragraph in the standard, AASB 136.20. Go and have a look at that, because if you're under fair value and your range is too big, you may want to just check whether it's appropriate to even be on the fair value side of this diagram, and you may have to go back to value in use calc. All right.
Yes, and Kevin, we might just put it in perspective, and that is, when we do impairment testing of assets, we use the highest of, on the left-hand side, fair value less cost of disposal, or value in use. Now, it's interesting, again, the terminology could be potentially confusing because we talk here about fair value less cost of disposal, and that is not exactly the same as fair value under AASB 13, right?
No, not at all.
But there's so many similarities. So you have to know, what are we doing? Is this fair value as it's put into an impairment assessment, or is this fair value as in to put a fair value on a balance sheet?
Absolutely, very different. And sometimes, especially if you're under the fair value standard for impairment, you're actually using AASB 13 plus AASB 36 at the same time, different approach rules. So that's why the little block in gray actually has the 2 in the block, and that's why suddenly COD appeared there, cost of disposal, because a whole new rule coming out of the impairment standard. This is a bit technical. I guess my point to you is, for those of you on the session today, is if you're heading towards doing a AASB 13 fair value measure for impairment for the first time, probably talk to your IFRS advisor before going down that path, because value in use is well understood, and maybe you're just updating last year's calc. But if you're starting to move to use a fair value measure for impairment, you're actually not doing a AASB 13 fair value measure alone without concepts from the 136 standard. And that might give you a very different answer if you're valuing it, let's say, to recognize it on the balance sheet, like Aletta says, and actually record it at fair value. Also a different answer again. So just make sure, once again, you got your framework approach right before you dive into this. Things to remember. Now we've got 2 minutes to go, and I am almost done. I actually have spoken about bid-ask spreads, unit of account, blockage factors, and control premiums already. I think covering it off, and I'm actually going to go straight down to control premiums and discounts. Blockage factors are the same. Essentially is make sure that you include control premiums or exclude control premiums, and the same thing for discounts, consistent with the unit of account. In other words, if I'm valuing an investment in subsidiary, as I said earlier, that's the entire interest, and you probably would factor a control premium into your valuation, and you'd brief the valuer accordingly. But if you're valuing an individual share, you probably wouldn't include control premiums, and you'd brief the valuer accordingly. I think I'd mentioned that already. This is, once again, just things to remember. Make sure your valuer knows what the unit of account is and what the inclusions and exclusions are, relative to that standard. All right, Aletta, I'm going to hand to you, because this is your section on education materials, and I'll let you wrap up.
Thank you very much, Kevin. I think listening to the session again, Kevin, and thank you very much for articulating all those problem areas. I think it's really clear that we really need to work together more with valuers, and valuers should work even more with the accounting experts, and that we should have those discussions before the valuation gets done, because we don't want to pay a lot of money for a valuation and then we have to redo, or they have to redo the valuation, and we pay a lot of money again. So I think there's some good rules and some good basic principles. And that whole thing of fair value versus impairment, and where are they different and where's the overlap, is really tricky. The ISB issued in December 2012, so this is 10 years ago already. They've issued a publication that accompanied IFRS 13, and it's all focused on measuring the fair value of unquoted equity instruments that are within the scope of IFRS 9 financial instruments. So if it's a quoted equity instrument or a listed entity instrument, it's a level 1 fair value. We can go to the stock exchange, we can get the fair value. It's very easy. But a lot of people over the years have tried to argue, if I have to determine the fair value of an unquoted equity instrument, I can't do it. Maybe it's too hard, it's not reliable, and therefore I want to use cost, for example. And IFRS 9 said, no. You have to make a best attempt at a reliable estimate. We don't want this cost exemption. People are just defaulting to a cost exemption. We really want entities to come up with a fair value of those unquoted equity instruments, and they should apply IFRS 13. And to help, the ISB have issued the educational material. I find this publication really helpful, so I thought I'll just flag it there for you. If you've in the olden days tried to use that cost exemption, please put that in the bin and consider this educational material. And I think that will be very useful. So if you need any assistance, obviously, please feel free to reach out to any of our IFRS and corporate reporting leaders. We can put you in touch with our valuation experts at BDO, or you can reach out to them. They will contact us, but let's speak and let's all communicate about this. I think that's really important. So thank you very much, Kevin. It's just after 12, so thank you for keeping to the time so amazingly well. You've set a high standard for me to achieve next time. I hope you all have a lovely day, and we'll speak again next month.
Goodbye, everybody. See you next time. Bye, Aletta.
Bye, Kevin. Thank you.